All right, let's jump right into this explainer and unpack exactly what is going on with Netflix's massive 2026 pivot. Right now, we're looking at a truly fascinating corporate paradox. On one hand, you have a company operating at a scale that traditional media companies could literally only dream of. But on the other hand, a sudden wave of panic has swept through the market, leaving Wall Street completely divided on what the future holds for this streaming giant.
We've got to start with an absolute blockbuster of a number: 325 million paid members. Just wrap your head around the sheer magnitude of that for a second. Because, with multiple people usually sharing a single account, that pushes their total global audience reach to nearly a billion people. Management actually noted in their recent earnings call that while they are entertaining a massive chunk of the planet, they estimate they're still less than 45% penetrated when it comes to addressable smart TV households, and they've only captured about 7% of the global addressable market revenue. So technically speaking, their runway for growth is still huge.
And this massive reach, it feeds a highly efficient financial engine. Because it's not just about getting eyeballs, it's about monetizing them efficiently. And boy, are they doing that. Netflix is boasting a staggering 40.92% return on equity. To put that simply, for every dollar of shareholder equity, they're generating almost 41 cents of profit. Combine that with a 28.52% net margin, and you have a business that has completely transformed from a cash-burning startup into a remarkably efficient, profit-generating machine.
But then, reality hit hard. Despite those jaw-dropping metrics, a sudden 13% stock rout just wiped out billions of dollars in market value in a matter of days. Pre-earnings, the sentiment was riding super high. Then, mid-rout, the bottom basically fell out, dragging the stock way down to roughly $73 per share.
So the literal multi-billion-dollar question is, what terrified investors so badly that they hit the panic button en masse? I mean, how does a company string together incredible global reach, exceptional profit margins, and a totally dominant market position, only to watch 13% of its market cap vaporize virtually overnight?
Section 1. Why did shares tumble? Well, it wasn't one single catastrophic failure, but really more of a perfect storm of shifting expectations and sudden uncertainty that spooked the market.
The sell-off was primarily sparked by a Q2 guidance miss. Now, first quarter results actually beat expectations, but Wall Street is a forward-looking machine. Management guided second quarter revenue just 0.5% below consensus. The real kicker, though, was Q2 operating income, which was guided 5% lower than expected. In a market that is priced for absolute perfection, any slight deceleration in growth is going to trigger immediate alarm bells.
Underneath that financial miss is a really fascinating shift happening in international engagement. We're seeing non-English content viewing drop from 71% down to 68%. That equates to roughly 4 to 6 billion viewing hours migrating away from non-English content. That is a massive shift. Now, part of this is demographic, like typical television consumption in newer markets like Japan naturally runs about 50% below US levels, but it still represents a high single-digit decline in international per-user engagement. When your domestic market is saturated, international engagement is your lifeblood, so seeing it slow down naturally makes investors super nervous.
Adding a very human element to all this corporate anxiety is the planned June departure of co-founder Reed Hastings. He announced he won't be standing for re-election as board chair at the coming annual meeting. This really marks the true end of an era for the visionary who built the company from that quirky DVD by mail service into the streaming titan we know today. And, losing a founder always injects a layer of unpredictability into a stock.
Faced with a leadership shakeup, a brutal stock drop, and big questions about international growth, we have to ask, how does management plan to win back the market's confidence? You certainly don't build a near-billion-viewer platform by sitting on your hands when the waters get choppy.
Which brings us to Section 2, the $25 billion pivot. Let's dig into the massive financial countermove that completely reshaped their 2026 strategy. This is where the story gets incredibly interesting, because it shows a management team making some very aggressive, definitive choices.
Before this earnings cycle, Netflix was actually heavily pursuing a mammoth $72 billion acquisition of Warner Bros. Discovery. It would have been a transformational, incredibly debt-heavy mega deal. Instead, they completely walked away, pocketed a $2.8 billion termination fee, and chose a totally different path, returning capital directly to shareholders rather than taking on massive M&A risk.
They unleashed a $25 billion stock buyback program. When you add that to their existing $6.8 billion plan, Netflix has over $31 billion ready to deploy right back into their own shares. This sends a very loud, very clear signal to the market. Management believes its own stock is an absolute bargain at these lower levels. It's essentially the board going on a $31 billion shopping spree for its own equity, aiming to stabilize the price and increase the ownership stake for everyone left holding the stock.
Section 3. Growth engines. Ads, AI, and gaming. Because, let's be real, you can't just buy back stock forever. You still have to build the future of the product itself. Let's look at where they are funneling their operational investments next.
They are leaning hard into next-generation technology, specifically generative AI, to empower filmmakers and massively improve production efficiency. This isn't just about replacing human creativity, it's about handing creators powerful new tools, increasing production safety, and driving innovation in how stories actually make it to the screen. Management specifically called out that generative AI tools are already helping make content better and boosting member engagement, which ultimately means a better viewing experience for us at home.
A prime example of this tech strategy in action is their targeted acquisition of Interpositive. And yes, that is the AI-powered video tech firm founded by Ben Affleck. Netflix bought it to rapidly accelerate their Gen AI capabilities, specifically tailored for filmmakers. What's wild is they're doing this while maintaining their commitment to spend roughly $20 billion on traditional content production this year. So they're essentially funding the future of AI production technology without starving their current traditional content engine.
Furthermore, they're expanding their ad tier incredibly aggressively. They have a stated goal to roughly double their advertising business to about $3 billion. And the underlying metrics actually support this ambition. They've grown their total advertiser base by over 70% year over year in 2025, reaching more than 4,000 advertisers. Even more impressive, programmatic ad buying is on its way to representing more than 50% of their non-live ad business. They are building a highly automated, highly lucrative advertising machine right alongside their traditional subscription model.
Beyond ads and AI, Netflix is also chasing a staggering $150 billion consumer gaming market. While management freely admits that their gaming investments are still pretty small relative to overall content spend, they are clearly focused on the incremental engagement and retention it brings. A perfect example is their recent launch of the Netflix Playground app, which is dedicated specifically to kids gaming. It's a really strategic move to lock in family engagement across multiple entertainment formats. Section 4. The Wall Street Verdict. With all these moving parts, the leadership exit, the $25 billion buyback, the huge push into AI and gaming, it is time to impartially examine how the financial world is pricing Netflix's future. The analyst community is looking at the exact same data, but coming to some very different conclusions. On one side, the bulls see an incredibly strong financial profile. They're looking at a highly undervalued PEG ratio sitting between 0.64 and 0.94, which suggests the stock is a bargain relative to its growth rate. They also point straight to those rock-solid 31.5% operating margins. Bears, however, are highlighting the risk. They point to high stock volatility with a beta of 1.52, some notable insider selling by executives, and an increasingly cutthroat streaming market where heavyweights like YouTube and Meta are aggressively fighting for every minute of watch time.
But despite all the recent turbulence, just look at the aggregate consensus right now. We've got 36 buy or strong buy ratings compared to just 15 holds and only one sell rating. With the stock currently hovering around $73, the consensus price target sits way up at $113.65. That represents a massive forecasted upside of over 55% from current levels. So Wall Street, in aggregate at least, believes that recent 13% haircut was a major overreaction.
So I'm going to leave you with this provocative thought to ponder. By walking away from a $72 billion mega merger, launching a massive $25 billion stock buyback, and betting big on AI and ad tiers, has Netflix engineered the absolute perfect corporate comeback? Or, in an era of slowing international engagement and departing founders, are they simply using their war chest of cash to buy time in a market that's already hit its peak? Think about what that means for the entire future of entertainment as you digest these numbers. Thanks for joining me on this explainer, and I'll catch you on the next one.